Hello, everybody. My name is Elisha Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. This is my thoughts on market happenings for the week ending January 20th, 2023. Looking at the market indexes for the week, the TSX, NASDAQ, S&P 500, and Russell 2000 were all up for the positive week. But the Dow Jones was down. Gold was up and oil was up as well. Looking at Canada, we had some good news on the inflation front in Canada, both in the core and headline inflation having come off and more than forecast. The month over months have been negative, in fact, so prices are coming down. The markets didn't even really react, so this was expected and priced in. So the core CPI month over month for December was actually down 0.3%, which was significantly less than the 0.1% up that was forecast and still better than the previous month. The core CPI year over year was still up 5.4%, but this was better than the 6.1% forecast and definitely better than the year over year ending in November, which was 5.8. The headline CPI, so including energy and food, which is more volatile, was down month over month 0.6%, still better than 0.5%, which was forecast, and then the November month over month, which was 0.1%. And the headline inflation year over year, which is what everybody looks at, was 6.3%, better than the 6.4% forecast, and much better than the previous month's year over year, which was 6.8. An interest rate cut is not going to happen, however, unless we get into a harsh recession. If inflation continues to recede downwards towards the 2% Bank of Canada interest rate target, the bank will pause. Since interest rates are at a neutral rate now and still low compared to history, there's nothing that says the central banks need to lower it back to the emergency lows that we're used to. If the economy is fine, employment is strong, and inflation has receded, the interest rates will be left as is. Turning to the Canadian consumer, the MNP Quarterly Canadian Consumer Sentiment Index is at a 5-year record low, with consumers being worried about their finances. Nearly half of Canadians say they are concerned about their current level of debt, and more Canadians are saying this quarter they regret the amount of debt they have gotten themselves into. 7 in 10 are feeling the effect of interest rate increases, and 3 in 5 say if interest rates go up much more, they'll be in financial problems. Nearly half of Canadians reported that they are $200 or less away from not being able to meet their financial obligations. Wage growth is also lower than inflation for Canadians. Amazon announced a large-scale expansion of their Buy with Prime last week. It streamlined payment and shipping services for unaffiliated retailers. It's a direct challenge to Ottawa-based Shopify and promising a new revenue stream for Amazon as it adjusts to the bust after e-com's tremendous pandemic boom. Unaffiliated retailers are Shopify's bread and butter. The US Fed approved BMO's Bank of the West deal, the largest transaction ever by a Canadian bank, and so it will close February 1st. BMO is looking to go abroad to get growth. Now let's take a little bit at Canadian debt. Let's compare debt of Canadian and American consumers as we head into 2023. Canadians are already more indebted than our American counterparts, who appear to have gotten considerably more cautious after the 2008 financial crisis, and the US deleveraged significantly during the Great Recession. We are also forecasted to see Canada's debt rise more dramatically this year as well. Mortgage debt is likely the main culprit behind these predicted trends. Not only do we Canucks carry more mortgage debt, but we tend to default to 5-year mortgage terms, whereas 90% of our southern neighbors have 30-year mortgages. The key thing to note here is that if your mortgage rate is set for the duration of the entire amortization, you can probably ignore the latest interest rate volatility. Whereas if your mortgage is coming up for new terms in the next 24 months, you're likely thinking about your monthly payment is going to look like. Canadians with a variable rate mortgage were particularly vulnerable, and that the percentage of mortgage credit on variable rate terms was up to 34% from 25% as recently as 2018. There could be some interesting second order effects here when it comes to interest rate decisions for the Bank of Canada and subsequent market reactions. Given how much more debt Canadians are carrying than Americans, one could assume that our wallets will be more sensitive to the recent interest rate increases. Note that the Bank of Canada doesn't particularly care whether you or the Canadian government, for that matter, can pay its bills and interest. The BOC does care about employment and strength of the economy. So if people stop buying and companies start letting people go, the central banks will intervene. Turning to the US workers lost ground to inflation despite big wage gains as real wages actually decreased. The US debt ceiling reached its legal limit on Thursday. The US government hit its 31.4 trillion borrowing limit on Thursday amid a standoff between the Republican-controlled House of Representatives and President Joe Biden's Democrats on lifting the ceiling, which could lead to fiscal crisis in a few months. From both an economic and financial perspective, a failure to raise the debt ceiling would be an unmitigated disaster. Today, as in the past, attempts to gain political advantage by holding the debt ceiling hostage amount to a juvenile game of chicken, and both parties deserve the scorn of voters for not eliminating this fiscal doomsday machine years ago. And we have the US weekly jobless claims coming in, and they fell to below 190,000. Now for some bits and pieces. Electric vehicles made up 10% of the total new cars sold globally in 2022, the highest percentage to date. The growth was mostly driven by sales in Europe and China, no pun intended. The global economic integration made billions of people wealthier, healthier, and better educated. Since the end of the Cold War, global output roughly tripled, lifting nearly 1.5 billion people out of extreme poverty. Countries should not squander this peace and cooperation dividend. In the last decade, the integration slowed and trade restrictions increased. Now, with onshoring or friendshoring being the directive, world trade could plateau and goods would be produced in higher cost countries, leading to higher prices for consumers. Looking at China, China is continuing its reopening after COVID with a surprise beat for the fourth quarter, 2.9% compared to the consensus forecast of just under 2%. China's GDP growth came in at 3% for 2022 as a whole. This will improve supply chains, which will help with inflation, but the additional demand for goods and oil could increase prices. Therefore, keep in mind that you can think of China's reopening both in a bullish way on improving the world economy and reducing inflation, but in a bearish way, it raises prices and overheats the world economy, and therefore the reopening could predict the central banks raising the interest rates more and for longer. China's population fell last year for the first time since the 1960s. Mainland China's population declined by 850,000 to 1.41 billion, China's National Bureau of Statistics reported. The update comes days after China reported that 60,000 people, mostly senior citizens, died from the coronavirus since early December as the country eased its zero COVID policy. According to the latest data compiled by Refinitiv, the Nasdaq Golden Dragon China Index, which tracks Chinese firms listed in the US, soared over 13% in the first 5 trading days of 2023, marking its best start to a year since 2003. In the first week of 2023, US listed shares of Chinese e-commerce firms Alibaba, JD.com, and Pinduoduo added over 123 billion to their combined market value. The surge comes after Tencent received 6 new gaming licenses and Jack Ma's Ant Group won approval for capital expansion of its consumer finance business a few days ago. And it marked another positive step in easing regulatory risks for Chinese technology companies this year. Since 2020, Chinese tech companies have faced a regulatory crackdown that drove investors away. In 2021 and 2022, the Nasdaq's Golden Dragon China Index plummeted 46% and 25% respectively. But now the story is changing. Softer calls for regulatory reforms have been in focus for months, and approval of Ant's capital expansion plans has fueled hopes that Chinese authorities want to improve ties with the private sector in 2023. It's all part of the plan to accelerate economic growth after their zero COVID policy battered their economy last year. And finally, let's look at next week. We have companies reporting next week in the US Q4 reporting. On Tuesday, we have Microsoft, Johnson & Johnson, Raytheon, Lockheed Martin, GE, the lone Canadian in the Canadian National Railway. On Wednesday, we have Tesla, ASML, Abbott Labs, AT&T, IBM, Boeing, and Hyundai. On Thursday, we have Visa, MasterCard, Louis Vuitton, SAP, Intel, Northrop Grumman, and Nokia. And on Friday, we have Chevron and American Express. The economic events next week, the big one is on Wednesday, where Bank of Canada is giving the interest rate decision. The U.S. oil inventories are also on Wednesday. On Thursday, we have U.S. continuing jobless claims, the U.S. GDP to see how they are doing economically. And we have the U.S. retail inventories. And Friday, we have the U.S. personal income numbers. So that concludes my thoughts for the week. If you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.